What's up, everybody? You're going to like this one. Today, we interviewed Dom Wells, the CEO of Onfolio. Dom took Onfolio public in 2022. So you're going to learn all about how to take a company public, holdcos, internet businesses, synergies, decentralized operations. We're trying some new formats on the DealMaven podcast. So let us know what you think. If you hate it, send me an email and let me know what you think. Raleigh@dealmaven.io. If you love it, give us a 5-star review because we need it. Enjoy. Peace. All right, what's up, Dom? How you doing, man? Great to have you on. I'm excited for this one. The first time that I came across Onfolio was I was doing research for a company in Utah, and the idea was these guys wanted to start a public holding company called Utah Inc., which is public now. They're out actively trying to find deals. And so I was tasked as kind of the deal guy to try to figure out what the public holdco companies were that were out there on the market. So obviously Berkshire Hathaway, Boston Omaha. I was just looking at as much of the public holding companies as I could. And I came across Onfolio, which was awesome because I'm also in digital acquisitions, doing it at a, obviously not at the public company level. And so as I was looking through your stuff, I was super impressed with everything that you had done. And so I'm stoked to get all of your thoughts, ideas, and what you're seeing out on the market there on the playing field as it sits today currently.
Yeah, great. I haven't done a podcast for a while, so I appreciate you reaching out. I'm looking forward to it.
All right. Tell me if I've missed anything here, but the Reader's Digest version of it is you were teaching English in Asia and became a digital marketer as a way to generate some side hustle income, affiliate marketing type stuff. Ultimately started an SEO agency, kind of website content management business that you sold in 2018 for 7 figures. It's 2018, 2019. And then started this Onfolio business. Does that get us up to 2019?
Yeah, it was a 6-figure exit, but yeah, that's
6 figures.
Pretty accurate so far. Yeah, it was like about 600, 700K.
Oh, nice. So what was kind of the next step for you on the kind of version 1 of Onfolio of what you saw post exit and what you wanted to jump into on V1 of Onfolio?
Yeah, so I already had the idea for Onfolio before I exited the previous company. That was kind of the genesis for exiting, because I think a lot of people go through this situation where they're like, I don't want to sell now because maybe I won't get the exit I'm looking for, and I've worked on this business for 5 years or 10 years. I don't really want to, only sell it for $1 million or something. And what would I do next? Whereas for me, I also had that kind of trepidation, but since I'd started Onfolio and I was a lot more excited about that and it was getting traction, I realized I wasn't doing a good service to the previous business and its customers and the team. And also I couldn't grow Onfolio properly. So an exit actually made sense. Plus it gave me some seed money to start Onfolio with. So the original iteration of Onfolio was, we'd identified that there were a lot of people out there who had money to invest in online businesses, but they either didn't want to or just didn't know how to do it. So with real estate, you can kind of do it yourself and it's fine, or you can hire people to do it for you. Whereas with online business, it's a pretty active investment. You have to buy the business and then figure out how to run the thing. So we were basically solving that problem. So we would say to people, okay, you've got 100K you want to buy a business with, or you've got 50K, or in some cases 500K. We'll find one that we think is a good investment. We'll talk you through it. We'll do all the negotiations and the due diligence and the migrations and everything, and then we'll manage the business for you after you purchase it. And I was already doing this a little bit myself with my own money and with some of the money that I got from my exit. So it was just a way to do more of it. So yeah, we did that for a couple of years before we kind of pivoted a little bit.
So my first job was working as a mergers and acquisitions lawyer. The first thing that I ever did as an M&A lawyer, I was working in M&A and cap markets. And the first thing I ever did was an S1, going to the printer, working with the investment bankers, doing all of the public filing documents for a business that ended up deciding to not go public because the market winds kind of changed on them. And so I think that experience for me, or that torturous experience for me, basically anytime I hear any entrepreneur or anyone who's working on a roll up, anyone who like mentions the idea of going public or accessing public markets, I just write it off summarily. I'm just like, no, it's not going to happen. There's zero chance. Like, it's more difficult than you think that it will be. You're making it sound a lot easier than it is. What was it that you saw that was like, I can go for this. This is doable amongst all. Obviously, you could have raised a fund or just syndicated deals or continued to advise. What was the thing that kind of pushed you into going for the let's take this thing public route?
Yeah, S1s are fun. It's definitely harder than it looks. It's harder than I thought it would be, but I also didn't think it was going to be easy. So I think for me, it wasn't so much what did I see that made me think I could do it. It was more what did I see that made me think it was worth doing.
Sure.
So, I mean, Onfolio had grown pretty quickly, so I was like full of confidence and believed I could do anything, like, you know, a lot of entrepreneurs do when things are going well.
The Midas touch.
Yeah, exactly. And you know, it turns out we probably made a ton of mistakes along the way. But I was in this position in early 2020 where we'd grown pretty well. We had something like 35, 40 businesses we were managing, but I felt like there was a huge opportunity in the space, but we probably weren't capturing it because essentially we were just a glorified agency. We were just running businesses for people. And so I thought, well, how can we do something bigger? And I was thinking, yeah, should we raise a fund? Should we do a private holding company like some other companies out there? And then I see all the FBA aggregators who were doing crazy things at the time. And I just thought, well, I want to do something for the next decade. And if I'm going to do that, I want something that's going to have a payoff where it kind of makes sense. And at the time, I was listening to Steven Schwarzman from Blackstone. I was listening to his autobiography on Audible. Yeah. And there's a quote which I may get it slightly wrong, but basically the idea is in order to succeed in any business, whether it's big or small, just whatever, you have to really dedicate your life to it for like, you know, 5 years or 10 years or whatever. But you have to live and breathe it. You can't really do it an hour a week on the side. And so if you're going to dedicate your life to something, it needs to have a big payoff. And so I thought I could do a fund. Maybe I could raise 10 million and I might earn okay by year 4 or something. Or I could do this or I could do that. Whereas going public, it's like the ceiling is very, very high. So essentially, you know, you can swing very big. So there was that. But then there were also a lot of reasons why I thought going public made sense. Like acquisitions are easier because visibility, trust, structure that you can do, credibility, and all of those things. And then talent attraction is higher, easier, sorry. And then in theory, it's hard to tell in this current climate, but in theory, acquisitions are, I said in theory, and Siri thought I was talking to him. Just started talking to me. I was like, okay, what was I going to say? Capital raising is easier as well, access to capital and debt and things like that. Capital. So I just felt like, considering what we're trying to do, it's probably easier to grow as a public company than a private company, and we can grow significantly larger. And if I'm going to be doing something for the next 10 or 20 years or the rest of my life until I retire, I want it to be something that could really just, you know, be, we could build $1 billion company. We just thought, okay, let's try it. If it doesn't work out, never mind. But, you know, let's see if we can actually pull it off.
How did you manage just the learning curve of that, going from operating and selling, you know, making a couple $100,000 on an exit, which is awesome, and, you know, being kind of like an agency for that, to just the sheer learning curve that has to go through and developing an S1, you know, trying to deal with underwriters, getting a market maker, you know, I mean, it's a massively intimidating process to do from Taiwan. I was like, what did that look like, managing the learning curve?
Yeah, there's definitely a lot of late nights trying to get something filed before the 5:30 cutoff, which is 5:30 in the morning here. But It is a very steep learning curve, but at the same time, it took us around 18 months from deciding to go public to actually IPOing. There was a lot of things to learn, but we kind of did it in stages. So in the beginning, it was just learning about really doing the audit, the public audit, and getting our books like gap friendly and doing that. And then once we started to go public and we found an investment bank, then it was like I needed to learn how to speak to investment bankers because they just use totally different language and they care about things like revenue, whereas we care about things like profit. And just the mental models they use is totally different. And the dynamic completely changes once you're public. Like before you're public, investment bankers are kind of like they just completely change. For me, the similarity I think was in the UK in secondary school, which is like high school, you kind of have 5 years where you're grade 7 to grade 11. And then you have 2 years in what's called sixth form, which is basically like senior high. But in sixth form, you don't wear a uniform and you're 17 years old and 18 years old. So the teachers speak to you like adults and almost peers. Whereas before that, they're like your parents. And investment bankers, like before you go public, they're very much like your parents and like judging every word you say. And you don't know what you're talking about. And when you go public, they're like, hi, how's it going? And so like my LinkedIn spam changes from people in like the Middle East trying to sell me SEO services to investment bankers trying to sell me like
a new
like
capital
raises. Yeah. It's like the dynamic change there is incredible. Just back to the learning curve, basically it's like one chunk at a time. So like, learning what a transfer agent is and what D2C eligible means and all of these things, it just happens like week by week or month by month.
And were you just traversing you were just lone wolf on this, or you had a partner that was like kind of egging you on into like, let's do this, we got this, let's go for it?
Well, yeah, I have team members who were with me along the way who have equity in the company, but we also had a couple of advisors who have done this before and have helped take companies public. And so there were a lot of training wheels that they helped with, and they helped explain, when you speak to an investment banker, they're not really caring what you say, they're caring how you're going to sound if they put you in front of clients. So it's not just about what you say, it's about how you present yourself. And so I'm like, okay, I better wear a tie. So it's like things like that. And so, like basically I couldn't have done it without like really good advisors around me.
If I were to come to you, this will be the last question. I'm massively interested in it just because I think it's awesome that you traverse that. If I were to come to you and say, hey, Dom, I'm thinking about either doing a direct listing or starting a fund or doing a holdco and staying private as long as I possibly can. If I were to come to you today in 2023 conditions, obviously with SPACs, and when you did it, it was a completely different capital environment in public and private markets. How would you advise me today at a holdco that has no acquisitions in it? I'm just figuring out, the best way to structure going forward.
It's a good question. I think in the current markets, it's probably not even possible. There's just so many funds that are just not doing IPOs. One of our biggest struggles was getting enough people to answer the phone. Like our investment bank just said, there's so many clients who are just like, we're not doing any IPOs. We went public in 2022, which was worse. I think 2023, we're starting to see a bit more interest. But NASDAQ put a memorandum on micro caps about September last year. So we got in just under the wire. So I'm not sure if they've actually started accepting them again. So you could still do a direct listing to like OTC QB or something. But I don't know. I think there's people out there who, I've only done it once. There's people out there who've done it hundreds of times who would be able to advise whether it makes sense now or not. But for me, I don't regret doing it. I actually think a lot of the thesis has come true. It has been easier to get deal flow conversations. It's been easier to attract talent, and it's been harder to raise money, but I think that's kind of the same if you're a private company as well. So I think the difference now is when we started going public, it was 2021 and people were just throwing money at ideas.
Yeah.
Whereas now you have to focus a lot more on profitability, which is like how it should be. So I don't know. I would have to think about it, but I think it's probably still the reasons we went public are probably still true today. It's just it might be harder to actually pull it off.
Yeah.
Yeah, like that. I imagine it's a big switch from selling your business to now you're CEO of a publicly made company. Like I'm really interested in like kind of what's like the day, like what kind of roles did you guys like kind of take on now to like actually be in that role? And like, what is your, I guess like your schedule? Like, is it looking over your portfolio? Like, what do you do now as like as a CEO of a publicly traded company now?
Yeah, my biggest focus is on capital raising and really a lot of what I'm doing now, a lot of content marketing and just a lot of conversations with people who want to learn about the company. So a lot of investor relations. We have a very good COO and a president, and both of they, along with the CFO, focus on the performance of the portfolio. Of course, I'm still like involved and I still check the numbers and everything, but their focus is working with the portfolio CEOs to make sure they get results and to help them where they need results. And I'm more like the kind of high level strategy plus thinking about different options for raising money. Yeah, so that's kind of my main focus.
And how did you find those team members? Like, is that someone from like previously, or did that come from going public? I guess like the recruiting got a lot easier since you're a publicly traded company now.
Yeah, well, the C-suite are people I've known for years. Our president, who's basically like the second in command, I've known her since I think 2016, and she joined OnFolio in the first 3 weeks of me starting the company. And our COO, Adam, I think I met him in 2014. We were both digital marketers, and we masterminded a lot and like had calls. And when we first raised money, I knew he was doing some good stuff in another company, so I basically went and poached him. And then our CFO started out as more like a fractional CFO who just did our bookkeeping and like advised us on our numbers, because a lot of online entrepreneurs are kind of pretty handicapped when it comes to understanding their numbers. So I needed someone like that. And so we actually started out with a different CFO who proved not to be a fit. When we were looking for a new CFO, we went to him and we were like, you understand online businesses, you understand the finance stuff. Maybe you've not, you don't know how to be a public company CFO, but like none of us really know what we're doing on that front. So we can handle the kind of external CFO stuff, like speaking to investors, and you handle all the actual like important compliance and controller and all of that stuff. So he started January 1st, but he's kind of been with the company since inception. And then the portfolio CEOs have been really where things have changed, because before we went public, we would attract just like kind of digital marketers like us, and we would optimize for people who were good at marketing. Whereas really now we optimize for people who understand marketing and all of those things, but really they know how to run an organization. And so we also decentralized in January. So, I mean, it's an ongoing process, but the original thesis was have one core team who run all of the businesses, because then you get operating leverage, and every time you buy a business, you just strap it into the existing team and you don't increase your expenses. But that doesn't really work. What you gain in savings, you lose in focus, and then the businesses decline and you lose those savings anyway. And then because of Parkinson's rule, the team just kind of expands anyway, so you don't end up saving money. So since we decentralized and we brought in dedicated CEOs to run all the companies, the performance has improved significantly, and the quality of the people running the businesses has improved. I think a core part of that has been because we're public, because we recruited a lot of these people from LinkedIn and places like that.
A lot of those operators at the portfolio level, are they mostly incentivized at portfolio operation, holdco performance, portfolio outperformance, some mixture of the two? How have you found the best way to incentivize at the portfolio
It depends
level?
a little bit on the individuals, but basically we've got kind of 3 buckets, I guess, and then depending on the individual, we tweak the weighting.
Today's episode is brought to you by the Exit Operating System. If you run a business right now and you are thinking about selling it one day and you want to know what you should focus on in order to maximize your exit value, go to exitos.io and sign up now. Peace.
So those 3 things are, one is obviously their salary, one is bonuses tied to performance of their business, and then one is stock options in like the whole of OnFolio. And then the stock options, they can be awarded more based on performance as well. So some people say, actually, I don't need a big salary. I'd rather have more bonuses, and I'd rather have the bonus tied specifically to my performance. Whereas others maybe want a more balanced weighting. Others prefer, maybe they live somewhere more expensive. They need a higher salary. So But yeah, it's basically you've got those three things, and then you kind of tweak the dial accordingly. But we do want everyone to have some stock options in the company, because then people are incentivized to help each other out and knowledge share. We want to be able to get the CEOs together, and both virtually and in person, so that they can they understand they're all working for the same company and rowing in the same direction.
So the last deal that I did, I bought 2/3 of a course business that is about teaching pharmacists how to do precision medicine. So I kept the entrepreneur kind of course creator in that business, bought 2/3 of it to help with the operations and kind of move the business away from the course creator as best we can over time. And I kind of think of it, I guess, in 4 buckets of an online service-based business, a more e-commerce focused business, kind of website content marketing, content website business, and then coaching info businesses. If you were to have your druthers, which model do you like the best?
They all have different pros and cons. I think the WordPress plugins are pretty interesting. The downside with WordPress plugins is there's not a ton of inventory for us to actually acquire, but
Sure.
those are good because they're basically software businesses, but they don't
SaaS,
they don't come with like SaaS pricing.
Right.
So you can still get them for a reasonable multiple.
Are those usually like single use, single purchase, or are those typically like recurring monthly WordPress plugin or like pay per use?
They're typically annual. So what's interesting about the WordPress ecosystem, and eventually I'm going to have to stop sharing this because I'll create too much competition.
I know. Like I gotta.
Basically, up until, I don't know, 4 or 5 years ago, I don't know exactly when it switched, but it was kind of taboo for any WordPress plugin developer to have a recurring charge. It would be like you pay $50 or $100 or whatever for the plugin, and that's it. You're not expected to pay again. And people would be outraged if you had to pay like a renewal fee. So then what they started doing was they'd say, well, you pay once for the plugin, it works forever, but I won't give you any support after a year, which I think is reasonable. And then it just started becoming, after a year, the license key doesn't work anymore. So you need to pay yearly in order to actually use the plugin. And the really good plugins, people were like, okay, fair enough, I don't care, it's a good plugin. And so now it's become a lot more normal. And that happened about 4 or 5 years ago, which means it's only just kind of now that you're able to find a plugin that has 4 years of recurring revenues in its history, so that you can actually start to do due diligence. But meanwhile, a lot of the kind of acquisition software entrepreneurs, they've all moved over to like the Shopify space. And so they're paying like 7 times revenue and other like crazy things. Whereas WordPress plugins, they don't get the high multiples because there's less competition and they're kind of less sexy. But also WordPress plugins are not really growing super fast like a lot of other SaaSes. Maybe people don't find that as interesting. But our model is around buying stable cash flows. So actually it's pretty good for us.
Do you find that?
So we might pay the same thing for a WordPress business that we do for a service business.
Sure. Do you find them stickier than like a WordPress? Because I was going to ask about Shopify, but it makes sense that there's more competition there. I have a couple of buddies that have VC funding developing Shopify plugins for the Shopify ecosystem. Is a WordPress plugin stickier than a Chrome plugin, or it's just purely the fact that there's less competition in the exit market, so you can just pick them up easier than a Chrome plugin?
I think there's a range. I think, for example, Gravity Forms has been around for years. They've got pretty sticky clients. Their revenue's insane. I think they probably do like $1 million a month or something. And you can kind of tell roughly how much a lot of these WordPress plugins do because you can just use tools like BuiltWith to see how many installations they have. And then you can just go on their website and see what their prices are. So I think, there's some that are very sticky. There's some that are not so sticky. But I think Shopify, it's a tough one because on the one hand, Shopify plugins probably have high churn, but they also probably are growing. So it's because people come in, they're like, I'm going to start a dropshipping site. And then after 6 months, they run out of money. Whereas WordPress users tend to be a little bit more sticky.
Stable.
But then they're not growing as fast. But WordPress is still growing as an ecosystem. It's only got like a 2-year lifetime and then people aren't going to use it anymore. So,
So my thesis, which I'll talk about less at some point as well. It has been something that you tweeted about recently, that basically the course business is just such a phenomenally cash positive business, with the downsides being typically it's built around an attractive character that sits at the center, and there's not a massively deep exit market. It's hard to kind of circle around on an enterprise value on most of them because there's such a key person risk in them. I'm interested to know whether you think course acquisitions, like the proofreading business, and maybe we don't have to talk about that one specifically, we can talk about it more generally, but are you bullish on that as a trend, or do you think it's always going to be just kind of like difficult to value course businesses and really exit them after you get in them? And hopefully I can find a way to sell the one that I bought into at some point.
I think sort of, if you look at the wider like online education, there's a lot of money pouring into that space. There's a lot of, I don't know about VC, but there's a lot of PE money. So like online
buyout money.
Yeah, like we do spreadsheet M&A. We don't know how to really run any of these businesses, but we'll pay 7 times for them. That type of money. Yeah, I think that space is only going to grow, and so courses are really the main kind of subsection of that. So I think there's always going to be someone wanting to buy a course. I think the challenge with a lot of courses is when it is too much wrapped around an individual, then it makes it harder to acquire. But I think there's layers there, because it's not like, oh, this course is wrapped around an individual, we can't buy it. Sometimes, 100%. Like it's someone just tweeting all day long and they have like a Gumroad in their Twitter profile. Sure, that's going to be a challenge. But there's other ones where really the personality of the business is just somebody doing YouTube ads or Facebook ads. And there's no real reason why it has to be that person. You could take them away and replace them with someone else. And so if you have the right strategy, which is basically you buy the business, either let them retain like 10, 20% and you can use their image, or you just say, look, we need to use your image and you need to keep recording ads for us for 12 months while we transition you into somebody else.
Yeah.
I think that's a much better way of thinking about it. So yeah, we're still bullish on the space, and we like the idea of kind of almost having a mini roll-up of courses where they're relevant to each other. But we'll probably be doing more acquisitions similar to the proofreading one.
I like that. And then I saw you had this really cool tweet the other day of like something around like, oh, if you're looking for cash flow or like passive income, like don't go buy a business. There's a lot of talk right now of like, oh, buying cash flowing businesses, like, build your wealth by, it's passive income. You just hire an operator, and you like said specifically, like hire an operator, like you're still going to be thinking about it. You're still going to be going like in your strategy of like going and acquiring all these different kind of businesses. Like you get another tweet of like the content, like there's a lot of courses, or you're talking about courses, like there's a lot of courses on Udemy, I don't know how to pronounce it, but they're not worth anything because they don't have actually any distribution. And so like, what do you look for in like a course business as like pretty good criteria of how you're going out and like making sure it's a good investment?
Yeah, I have no idea how to pronounce it either. I always call it Udemy.
I always say Udemy, yeah.
Yeah. It needs to be something where, I mean, this is kind of true for every business, like it would apply to a service business as well, but it needs to be something where it's not just reliant on a single channel or a single founder for generating all of its revenue. So there's like tons of people on Twitter who are really good at content marketing, and then they have courses. But if the Twitter algorithm changed, that course is going to lose all its revenue. And then there's a lot of courses that just maybe they teach a strategy that might not work in 2 years. And without that strategy, the course isn't there. So for example, if you had an SEO course, that's evergreen because maybe in 6 months or a year, some of the strategies that the course teaches become obsolete, but then you can just update the course and teach other things. Whereas if you have a course that's like how to grow your Twitter following using this strategy, and then later nobody wants to use Twitter anymore, like your course is gone. Or if you're teaching in SEO, there used to be quite a few courses about building PBNs, which is like an SEO strategy that isn't really done anymore, or at least talked about. And so if you bought that course and then 2 months later nobody cares about building PBNs anymore, nobody's going to buy your course anymore. So I think the topic of the course needs to be evergreen, even if the content needs to be updated. We just don't want it to be too reliant on a single channel for all of its sales, unless you have a lot of control over that. So if it's like Facebook ads, that's kind of a lot easier. Whereas if it's like a YouTuber who just creates content every day and has a course in his bio, then that's a lot harder to replicate.
Of the acquisitions that you've done, I know I have a couple of these myself where I'm like, what's been kind of the crown jewel, the one that you're, and maybe you can't pick your favorite children, but the one that you're like, if I could get 10 more of this one specific one, like I would do this all day, because you never really know. I mean, you do as much diligence as you possibly can, but then once you get the keys handed over to you, then you really get a sense of underneath the covers. What's been your favorite? Who's your favorite child thus far that you would do 20 more of if you could just find them?
Probably the WordPress plugins we bought.
Yeah,
I like the agencies we've bought, and we've bought some agencies for a great multiple. And I like the proofreading business. It's really a course business. It's teaching people how to build an income online. That's what it really is.
BizOp.
Yeah. So I would buy a lot more BizOp courses, especially as then you have the ability to cross promote and build a real audience focused on BizOp, because then you can also sell them SaaS tools and so on. But as standalone businesses, the WordPress ones are good just because the revenue is just so consistent. Like every month, the revenue is just more or less there. Like, yeah, you have good months, bad months, but typically it's just so reliable. Like you kind of, it doesn't give you any anxiety. Whereas other businesses, like maybe it's halfway through the month and you look at the revenue and you're like, oh, okay, I'm just going to close that spreadsheet down. So yeah, sometimes they have fewer levers to pull though as well, because like a service business, if you're having a bad month, you can just email your customers a discount code.
Yeah.
And same with a course. Whereas with WordPress, it's kind of like you can do email marketing and it will bring sales in the door, but maybe it doesn't have such a big impact. So I think for a marketer, a WordPress plugin business probably is really boring. But for someone who wants consistent cash flow, it's hard to beat.
Who's your least favorite? Maybe not your least favorite child, but the one that has required more work than you initially expected to get it on trend. Yeah.
I think the biggest surprise we had was with Mighty Deals, because we kind of underestimated the amount of technical debt we might get with that business. So the code hadn't been updated it was using a very old version of PHP, to the point where when I hired my developer and asked him to look at it, he couldn't initially read the code. It was using like a 10-year-old code base. And like Soliloquy PHP had updated so many times that Symfony PHP had updated so many times that he was like, what even is this? And so it was quite a big project to update the code on the site. A lot of things we wanted to do, like, okay, we want to add an order bump to the checkout. We want to add subscriptions. A lot of those things had to be put on hold until we finished updating the website. And also there was like, we couldn't not update it because it's old code. You're likely to get hacked and things like that. So that was just a complete oversight in the due diligence. So that was really frustrating. But now every time we buy a software business, we have like 3 or 4 different people do a code review as part of the due diligence. So it was also a learning curve. Yeah, that was the one that was really like the biggest frustration.
What's your like ideal thing? Acquisition size? What are you looking for these days? What's the lure that you got out in the water?
I think really something needs to be making about 500K a year profit, because anything below that, there needs to be enough like margin there that you can hire a new CEO if you need to, or the CEO can hire a VP of sales or something like that, depending on the business. And it's kind of in this sweet spot where it's got enough meat on the bone, it's got enough room to build a team, and probably it's got some diversification in its revenue streams by this point. But at the same time, it still has room to be optimized. There's still room to grow. Yeah, there's still opportunities, and also it's not so large that you have to start paying like 6 times or 7 times to buy the business. So And also there's less competition because you're still a bit too small for private equity, but too big for, individuals, unless they're using an SBA loan, and then you're already winning if they're using an SBA loan anyway. So
Right.
yeah, basically it's a pretty good sweet spot there.
As far as like the decentralized leadership or decentralized like operations process, like I guess a con to that where you can't like like do you just have like you buy a business, you're like, okay, this is our playbook, like we know exactly what works, like we just put this on and it starts cash flowing. Like, is that still a piece of that, or like is every business kind of new and it's on its own thing and you have to like kind of remake? Do you have like some kind of like a operational, like initial, we acquire it, initial acquisition, like here's the exact playbook to go, and then we can, push it off by itself?
There's things there's kind of like best practices, and there's things that we always identify, but really no real business we've ever seen is like, no two businesses are really alike. And so I think the mistake a lot of people who are doing more centralized roll-ups make is they assume like, oh, we can just buy the same business over and over again and do this repeatable playbook. And like, all the FBA aggregators definitely learned that lesson the hard way. I feel like I hit on them every single podcast I got.
No, they're easy targets. I think they deserve to be hit on.
Just a really good example of like sort of the opposite of how we do things. When we're doing our due diligence, that's where we're kind of identifying what we think our playbook's going to be. So if it's a business that, let's say it's a service business, we're going to look at what opportunities are there for improving the operations. Is there anyone on the team that is not as good as they could be? Are there holes in your funnel? Is there opportunity to improve paid traffic by spending it more efficiently? Is there opportunity to add different channels? Are there email list is a big one. Usually they don't send enough emails to their customers, or they're not doing a very good job of it. So really our kind of playbook we run every time is almost like a checklist of things that can be improved with the business, and the actual things that can be improved are different every time. It's kind of funny because you often see someone sharing a case study like, here's how you grow an e-commerce business, or here's how you grow a course based on this thing I did once or twice. So there's like a lot of survivorship bias. And the more businesses you run, the more you realize, well, none of these things work every time, but every time one of these things is going to work. So, really our job is just kind of like collecting as many different things as possible so that you run the gamut every time and see which things are going to work. So yeah, we don't necessarily have that central playbook, but I'm not sure if I kind of feel like it's a bit of a myth anyway.
If anyone does, yeah. Well, that's like it's like, I feel like it's almost more of a marketing for private equity or venture capitalists on like, this is, value add playbook. And maybe if you're a growth equity firm that buys restaurant businesses over and over and over again, and you just stay in one segment. But I don't know many holdcos, especially decentralized holdcos, that I just don't know how, you can't be in that many segments and make it happen. One of the questions from Twitter that I thought was a good one was, what are your growth expectations of a business after acquisition and CEO hire? Do you just kind of assume for the first year growth maintains stable from pre-acquisition, or how do you think about post-acquisition growth and pro formas?
It definitely depends on the business, because they're not always growing at a stable chop when you buy them, because sometimes the seller's kind of taken their foot off the gas a little bit. So you don't want to buy something that's completely tanking, but sometimes they might be declining a little bit, or they're holding steady. We actually usually assume there's a little bit of a dip post-acquisition, like maybe the first month or two things go well because the seller's involved still, and they're kind of like panicking that the business is going to die without them. And then as you start to transition, there's just things that you weren't aware of, or you didn't put enough importance on, or like the seller just kind of did instinctively and forgot to tell you. And so there's a little bit of a decline, and then it takes a few months to kind of, get back up again. And we certainly saw that with, actually not every business. Like our last 4 acquisitions, one of them declined quite a lot and is now back to where it should be. One of them grew for a couple of months and then now has kind of gone back to where it was. And one of them just stayed exactly where it was. So that's, I consider that a win. and another one, that one also stayed where it was. So it does vary, but we assume there's going to be a dip, because then if there is a dip, you're not surprised. So how we incentivize the CEOs is, as well as talking about like the bonus and everything we talked about earlier, but their goal is really to grow revenue and profit, because obviously if you incentivize them to grow revenue, they can grow revenue without at a loss, and we've had that happen. But if you optimize profit, then they might just fire everybody. So you kind of have to, so we're like, we want revenue to grow this much, profit to grow this much, and it's really on a per entity basis. So this is something our president does. She looks at everything. She creates like a matrix where it's like, okay, if this is the first year number, you'll get this bonus. If this is the first year bonus number, you'll get this bonus. And then run it past the CEO to be like, do you think these numbers are attainable? But it's usually like single digit growth. We're not like asking them to double a business in the year. It might be like, really, we're like, in the first year, as long as we don't fuck everything up, like that's a win. So if you can grow it 5%, that's a win. If you can grow it 20%, that's a win. If it only declines 5%, that's also a bit of a win. Yeah. So we also look at like cash on cash returns as well. So if we're normally paying around 4 times EBITDA, then we want to hit 25% cash returns. But like if they only hit 20%, that's fine, because the way we look at it as well with deploying capital, if we deploy capital on an acquisition, we want to get a higher return than if we deploy it in a business, in an existing business, because less risky, or more risky if you're acquiring it. So if we give a CEO, let's say the CEO, he or she's like, hey, can I have 500K as my budget next year? We might only expect them to get 15 or 20% on that budget. Whereas someone who wants 500K for an acquisition, they've got a higher bar, because just more things can go wrong.
Totally.
So this is still an evolving thing. There's a lot of theory crafting, but this is kind of where our thinking is at the moment.
What's the biggest barrier that you're trying to tackle right now? Is it just capital raising and just decentralizing operations?
Well, that's kind of coming to the end. Like, we've been doing that for the first part of the year, and everything's pretty much decentralized now, or everything that should be. Really, the goal is to reach profitability, and we're pretty confident we can do that without further acquisitions. But obviously, we're an acquisitive company, so we want to make acquisitions anyway, and they would certainly make our task easier. So the challenge is raising capital without diluting existing shareholders, without taking egregious debt terms. So that doesn't give us a ton of options in the current market, but like that's we have irons in the fire, so it's just about working through them and seeing what makes sense. Fortunately, the acquisition market is far less frothy than it was a couple of years ago as well. So sellers are a lot more flexible. So it kind of goes hands in hand. The challenges we're facing are also opportunities. So hopefully the public markets will recover before the private markets, and then we'll have this 1 or 2 year period where we're able to make a lot of acquisitions very easily.
Are there downsides in being a public company at the M&A table that you weren't expecting?
Because when we make an acquisition, if it's more than 20% of our our revenue, or
you got to report
our balance sheet, we have to file the 8K, and some sellers don't want us to announce how much they've sold the business for, and we're like, okay, well, it's not an option for us. We have to. So we've had 1 or 2 people not want to continue a conversation with us because of that. On the flip side, a lot of people want the prestige of saying they sold to a public company. So there's actually, probably it nets out. But that's been the real negative of being a public company at the M&A table.
And I'm sure you could do stock deals or warrants. I mean, it gives you so much more flexibility to use your brand.
Yeah, we have a preferred share as well. There's a lot of transparency. I mean, overall, it's a win for sure. Like, definitely, some dude in Taiwan wants to buy your business. It's like, I'm not sure about that. But like, a public company listed on NASDAQ wants to buy your business, and the CEO lives in Taiwan. It's like, oh, okay, that's a much different story. So
that's great. Yeah. Well, I appreciate the time, dude. You've reopened my eyes to the very beginning of my journey, where I said, never again will I need to know anything about an S1, and maybe in my future I will need to know, so you've brought it full circle for me. Where should people find you? If I have a business, I'm going to sell you one of my course businesses in about 6 months. I just got to get to 500 grand and I'm going to send it your way. So where do people do that? What's the best way to get in touch?
I mean, the best is probably email, which is just dom at onfolio.com. But also, as you've kind of mentioned a few times, I'm pretty active on Twitter as well. So my Twitter handle's Dom Wells on Folio. Yeah, that's a great place to follow me as well, just to see thoughts that I'm sharing and stuff like that.
Dope. We'll get it done.